All right, let's dive right into this explainer and unpack the intensely multi-layered financial debate surrounding Tesla as of May 18th, 2026. Look, if you've been following the markets at all lately, you know that Tesla isn't just a stock right now, it is an absolute battleground. We've got these sweeping, grandiose narratives of global AI dominance clashing head-on with the very harsh realities of margin compression and some seriously fierce new competition. So instead of getting lost in all the daily noise, we are going to look at exactly what the data is telling us today.
Here's our roadmap for today. We're going to start with the state of Tesla, look at the hard numbers, and examine the sentiment and macro forces at play. Then we'll weigh the bull case against the bear case before finally landing on our final verdict.
Okay, Section 1, the state of Tesla. Let's anchor ourselves in the current market reality.
So the absolutely crucial point we need to start with is this exact number. Tesla closed at $422.24. Now, this isn't just some arbitrary price point, right? It marks a really significant recovery from the $380 range we saw earlier this month. The stock has definitely been on a tear, but as we're about to see, this specific price level puts it at a very, very precarious tipping point. Moving right along to Section 2, by the numbers. Let's dig into the technicals and the fundamentals.
Check this out. Notice how the current price is hovering almost exactly at the 10-day EMA. I mean, we're talking 422.24 versus 422.22. That is a classic tense moment of consolidation. But if you look at the broader momentum indicators just below that, we've got a MACD sitting at 15.32, which shows some really strong bullish momentum. Plus, the RSI is at 57.96, meaning the stock isn't actually overbought yet, so technically it still has room to run, but it's clearly taking a major breath right here at that 10-day moving average.
And on the fundamental side, well, we're looking at a total paradox. On one hand, Tesla has this unbelievable $44.74 billion cash war chest. That is an incredible amount of liquidity. But that safety net is paired pretty uncomfortably with a razor-thin 3.95% profit margin and a towering forward PE of 161.72. The market is basically pricing in massive exponential future growth, but right now, today, the company is burning about $2.4 billion a quarter on CapEx while squeezing out some very tight margins. Which brings us to Section 3, sentiment and macro forces. Let's try to cut through some of the noise surrounding this stock. Because frankly, the macroeconomic backdrop is flashing some serious caution signs. We're seeing Middle East volatility that's driving up both oil and inflation, and that in turn is causing some very active professional hedging in precious metals like gold and silver. Add in a shaky consumer who's dealing with rising retail costs, plus a general big tech and NASDAQ sell-off. You've got some massive headwinds for any consumer discretionary company, let alone one that's priced for perfection. But here is the wild part. If you look at retail sentiment from places like StockTwits, retail traders are reacting to all this macro noise by aggressively trying to buy the dip. You can see right here that the bullish messages are significantly outnumbering the bearish ones, 27% to 13%. So despite the nasty macro headwinds, a really vocal segment of retail investors sees this consolidation phase as a massive buying opportunity. Let's explore why that is in Section 4, the bull case, transformation and the AI ecosystem. You see, to the bulls, that crazy high forward PE and those painfully tight margins, they aren't weaknesses at all. They are actually signs of aggressive reinvestment. The bulls firmly believe Tesla is leveraging that massive $44 billion cash reserve to just outlast the competition, spending heavily on the AI and manufacturing capacity that's going to define the next decade of mobility and robotics. So to a bull, that $2.4 billion quarterly capex isn't an expense. It's the construction of an absolute impenetrable moat. On the flip side, we have Section 5, the bear case, execution gaps and valuation traps. The bears point straight to this really alarming downward trend in net income as their primary piece of evidence. I mean, look at this. We've gone from a robust $1.37 billion back in Q3 of 2025 all the way down to just $477 million today. And when you combine shrinking net income with a forward PE sitting over 160, bears will argue that there is absolutely zero margin for error here. The slightest hiccup in the broader market could just send this stock tumbling. And this brings us to the ultimate tug of war regarding autonomy, which is honestly pretty stark. Bulls look at the current rollout in Texas and they see rigorous validation, right? They see the gathering of billions of miles of real-world data to build an unstoppable intelligence platform. But the bears, they look across the globe at rivals like Xpeng, who have actually launched real functioning robotaxis in China, and they see a massive execution gap. They argue that Tesla is basically losing its crucial first-mover advantage while it's stuck in beta testing. Then there's the upcoming June SpaceX IPO, which just further divides the analysts. It perfectly highlights this debate between a rising tide versus a dangerous diversion of cash. Bulls believe a massive SpaceX IPO is going to create this halo effect, validating the entire Musk technological ecosystem and driving up positive sentiment across the board. Bears, on the other hand, view it as a total liquidity drain. They see it as a mega event that will suck billions in institutional capital right out of the AI and tech sector, leaving stocks like Tesla starved for fresh investment.
We also really can't ignore the leadership optics here, specifically surrounding Elon Musk's recent legal loss against OpenAI. And depending on who you ask, this is either completely brushed off by the bulls as a total nothing-burger distraction that doesn't change the underlying technology one bit, or it's flagged by the bears as a severe key person risk. Those bears argue that institutional investors absolutely hate uncertainty, and they'll apply a valuation discount to any company whose CEO is constantly embroiled in high-profile legal battles.
All right, Section 6, the final verdict. Let's look at the research manager's take on all of this. So, after analyzing all this data, the research manager has ultimately settled on an overweight stance. Despite the terrifying valuation and those very real execution risks we just talked about, they believe the bullish technical momentum and that massive $44 billion liquidity buffer ultimately outweigh the immediate fears about margin compression. In their view, the technicals suggest this current consolidation is a springboard, not a ceiling.
Now, if you are mapping out a strategy based on this explainer, the action plan is highly specific. Step 1, do not chase breakouts. Scale in during this consolidation phase near the current price, or wait for a pullback to the 50-day moving average around $386.78. Step 2, you've got to keep a strict stop loss just below $407.40 to protect yourself if the trend breaks. And step 3, keep your position sizing moderate, because with a daily ATR volatility of over $17, you know this is going to be a seriously bumpy ride.
Ultimately, the bullish optimism that leads to that overweight rating hinges entirely on this exact sentiment, that you are investing in a future robotics and AI ecosystem rather than judging a present-day auto manufacturer on traditional, outdated car company metrics. So as we wrap up this explainer, I'll leave you with this question based on the data we've covered today. Are you siding with the bears, believing this stock is priced for a flawless miracle that might simply not arrive on time? Or do you stand with the bulls, believing that the massive cash reserves and that deep data moat make this the inevitable transformation of global mobility? The data is all right there on the table, but the final verdict? Well, that's up to you. Thanks so much for joining me, and keep questioning the numbers.